Hello traders. In this video, I want to continue the topic of analyzing the chart without technical indicators, using strategy and price action levels. And in this particular video, I want to talk about trend lines and trend channels. The way traders can use them for their trading is how to use them for entry points, trend confirmation, to find good stop-loss options, and so on, for many other tasks. We will talk about all this in this video. I will tell you what trend lines are, how to build them correctly on the chart, and also share a good strategy on how to filter signals on trend lines. Many traders, when they start to mark some levels on the charts, limit themselves to support and resistance levels. They draw only horizontal support or horizontal resistance, from which they look for bounces up or down. And yes, support and resistance levels work well, show good signals, but only in flat charts. When the chart has no clear trend and the price moves about like this up and down, up and down. On trend segments, when there is a clear trend on the chart, resistance support levels stop working. For example, if we mark a level here as resistance and a level here as support, then every time the trend continues, the support line will break down. Or if the trend is upward, the resistance line will break upward every time. And in this case, support and resistance levels will give false signals. And trend lines act as a kind of diagonal support levels of resistance. In a trend, we can also line up local highs and local lows. And in this case, support and resistance will not be horizontal, as usual, but diagonal. And it's not just a coincidence either that the price will bounce roughly off the trend lines every time. Here too, there's the usual market logic of how an ordinary trader behaves in a situation when he sees the beginning of a strong trend. First of all, a trend never goes exactly down or exactly up. Sooner or later, he's going to be corrected. And when we see that candles with long tails appear on the chart, we see the reversal of the figure. We see they're likely to hit a correction soon. Many traders will start buying here because firstly, the price will be acceptable for them, and secondly, the correction should start soon and they make money on it. Further, when the price rises a little bit, another group of traders is involved who want to join this departing train, this trend that has emerged, and they wait for the trend to continue and start selling here. Many traders start drawing trend lines here and see that there should be a rebound soon. The rebound occurs, the price rises, and at this price, it is already profitable to sell to someone. And all the more we know that somewhere here is a trend line from which we need to make deals downwards. So what is a trend line? This is a line that is drawn from several local highs or lows. In this case, we see that we have 1, 2, 3, 4 local high points where the chart has turned down. We can draw a trend line along these lines. At the bottom, we have local minima here, which are the first, second, and third reversal points where the price has turned upwards. And if we connect these lows, we get a lower trend line, and they will organize a trend channel within which the trend is very likely to move. And every time we expect that when a chart approaches a trend line, that it may bounce at that moment. Now let's talk about how to properly build trend channels and trend lines. There are some very important rules here. First of all, many people often use how to build a new channel by candlestick bodies or tails. But even with this example here, it is possible to build like this, and for example, like this, which would be the right way to do it from a technical analysis point of view. In fact, this argument is pointless because real trading on a real chart is not a picture from a textbook. There will often be situations here where the chart will dip just below your specified trend line or just above, like here, or it will not reach it and will turn around a little earlier because this chart reflects the trades of real traders and it never moves along any perfectly accurately drawn lines. Therefore, we think of each trend line as a zone. That is, if we had the option to make the line a little thicker, it would be more correct for us to expose it like this at least. And even so, consider that there is still an up and down indentation on which the trend line will still be valid, and the signal on the line will be valid, For example, we put out a thick line and consider this zone from below the two lows. That's the second rule, by the way. The second rule is that we draw the trend line at least on 2 points. We have one minimum, the second minimum. This is where we can already draw the line. And we're expecting that on that constructed line, the next time the chart goes, the next time it touches that line, it's going to bounce up. We can see clearly that the chart is touching and growing upward. We can see that the price has gone a little bit lower. And those kinds of punctures happen. That's why I say the trend line is more of an area of a little bit down retreating, a little bit up retreating. And in that whole area, the trend line will be valid. We can perceive buy trades. When we have a third point, we can tweak the trend. We can rotate it or adjust it to the new existing chart. And the next bounce will be more accurate. When the price just approached our trend line, touched it again, we again see an upward bounce. And that's the third rule of drawing new lines. The more points you use to draw the lines, the stronger it is considered. If the line has made two terms, that is, if we only have 2 points, it means it is a weak initial trending line. But if you already have 3, 4, 5 bounces off of it, it's a strong level that many traders will make trades from, and it's getting stronger every time. The fourth rule of trend lines and trend channels: trend lines will not always be parallel to each other. In this particular case, we have a clear trend. This is called a trend channel when the lines are approximately symmetrical to each other. And within that channel, the trend will move pretty clearly in one direction. But trend lines can also be non-symmetrical, such as in this case. We have a trend line on the lows like this, and on the highs like this, even a little bit lower, even like this. You can build it like this. Here's just the exit, and these are the points we draw the line on. Such trend lines will be called wedges or triangles. They are called by different names in different literature. And when we see a wedge like this, it gives us even more information about the chart. First of all, if the lines are getting closer to each other, it means that the market is losing volatility. It used to be a broader trend, but now volatility is falling, and the chart is moving to the so-called range market in narrow fluctuations. This indicates that, first of all, volatility has fallen, and soon after this stage of accumulation, there will be a sharp spurt up or down. Secondly, it can even give the direction of the trend because the wedge rising in this case is both lines pointing upwards. Or maybe a downward trend where the lines will converge and point downward. Such uptrends, ascending triangles, usually open upward. We can look for a good breakout point here. By the way, here's when we have a triangle getting more and more compressed. That means an up or down breakout is imminent. If the wedge was downward, meaning both lines were pointing downward, we would be waiting for a downward breakout. Also, such lines can be divergent. That is, not approaching each other, but on the contrary, diverging. This tells us that volatility in the market is increasing and rebounds. The rebound length gets longer and longer each time. This tells us that the volatility in the market has increased, and it is quite possible that the trend has already basically stalled, and we need to wait for a flat transition. Let's try to set the trend lines on the chart according to our rules. Here we see the chart, and it is not even obvious that there is a trend here, but we can set the lines, as we agreed, by maximum and minimum on the chart. If you max it out, it will look something like this. Let's say we don't see this part, we just set it up on these 2 points. We have 1, 2, 3 points that we can put a trend line on. We can do the same at the bottom. We have 1 point where the graph unfolded a second, a third, a fourth. Let's assume that we could build a trend line only on these 2 points and then orient ourselves on it. We have built a trend channel. It is quite symmetrical. That means the trend is more or less steady. And then we are at this point when the chart is. Here we could already build a channel. We have 1, 2, 3 points from the top and 1, 2. 2 dots at the bottom. We followed all the rules. Further, being at this point, we wait for the chart to approach one of these lines and wait for a rebound at this moment. The chart starts to fall. and returns to the upper line. This is where we're already expecting a bounce. As I said before, trend lines are resistance zones, so the chart can go up a little bit or fall a little bit short of the zone. In this case, it went up a little bit, but it still gave a good signal. The price is down. As you can see, in this case, the price has slightly missed the trend line, but again, we take into account that this is not just a line, but a support zone, and we have a nice upward bounce from here as well. Further here, the signal works clearly. We could even correct the trend line on these lows, and we see a bounce up. Here again, just a little bit short of the lines. But we, again, can interpret this as a valid signal for a trade down. By the way, right here, if you extend this trend line along the previous lines, the bounce can also be considered valid. Yes, it has gone just below our lower trend line, but as we said again, it's not just a line, it's some kind of support zone. Therefore, such a signal can also be considered valid for an upward bounce. But at some point, there is a breakout. The chart cannot move in your trend channel forever. We see a breakout and a clear candlestick fixation above the trend line, and that tells us that the previous trend is over, and now there may be a reversal to an uptrend. And to avoid such moments, to avoid the moment when trend lines are no longer valid and we have a new trend, we need to use these trend lines not as separate tools, but in combination with something else. I recommend using the stochastic indicator. I will remind you that the stochastic indicator shows overbought levels when the chart is too overbought and is above the average chart values. And there are oversold zones when the chart has been falling for a long time and it is already time for an upward correction or for a trend reversal, that the chart is already oversold and the price is already too favorable to buy. The signals are very simple. When you have both stochastic lines above, that is above the blue zone, that is in the overbought zone, it is a signal to trade down. When both lines are in the oversold zone and go back up, this is a signal for an upward trade. So we can check each of our trend line signals by stochastics as well. The first signal, one line, has entered the overbought zone and is coming back down. This can be used as confirmation for a down signal. Further, only one line has entered the overbought zone, but we can use it as a confirmation because then it came back. Further, both lines have entered the oversold zone and are coming back. This is a clear confirmation of this signal, and it worked well. It didn't reach the trend line, but we see stochastic that both lines have entered the overbought zone and are coming back up. We can use such a signal for a down trade. It's a good validation for our deals. But what happens next? This particular signal right here. You can see the chart is touching the upper trend line pretty clearly, but the stochastic signal does not confirm any of the lines. Even the blue one has not entered the oversold zone. That's the kind of signal we'd miss. Yes, he is profitable, but now you will see that if we follow this rule, he will sometimes be difficult to discourage good trades. But here at this point, when the breakout happened, you see, the candle has already touched. At this point, the upper resistance lines. But stochastic is still in the blue zone. He's not confirming the signal to us. And then we already see a breakout on the next few candles, and we wouldn't be using that signal anymore. And this filtering through stochastic would allow us to avoid this false signal and get out of the trend channel in time to stop considering it valid. Just like that, using rules like these, you can use trend lines in your trading. They work especially well in combination with other technical tools. You can use something other than stochastics, but personally, in my experience, stochastic gives the best statistics, the best indicators for this strategy. Write in comments your experience of trading on trend channels, and see you in new videos.